Let's have a look at the Philippine Stock Exchange's closing numbers now. The local bourse continues to recover. On Wednesday, the main index climbed 1.13%, close at 62.95. Value turnover was at 3.6 billion pesos. Now you might ask, can the PSE sustain recent rallies with no clear catalyst at this point to prop the market? ATR Asset Management Sandra Araullo is on the Business Roadshow today to weigh in on equities and other economic challenges that would influence the way people are investing. Hi, Sandra.
Hi, good afternoon.
Okay, it looks like good news today. We're heading straight to the markets first. Share prices up a second day, more than 1%. We almost touched 60. In fact, we did touch 63 intraday. Now, is it because there's some demand now for equities, assuming the price levels are already beaten down and the general market oversold since last week?
Yeah, we're definitely seeing some bargain hunters coming in, considering that the PE multiples are really cheap, no? 11.5 times for 2023 earnings and as low as 10.3 times for 2024 earnings. The last time we saw the market this cheap was at the height of the lockdowns, the first time that in March 2020. So the uncertainty at that time, as you recall, is really unprecedented. And so to see the market this heavily discounted is showing some divergence of market price to fundamentals. So that's why we're seeing a lot of, or some investors picking up the market at these levels.
And Sandra, some of the highlights also for today's trade, we saw industrial and even the holding sectors moving really up, significant value changes there at more than 1%. Now, remember, these sectors were also the ones beaten down recently. They haven't been doing well. Is this a recovery you're seeing?
I think it was an overreaction to the disappointing GDP print that we recently had.
Okay.
Generally, conglos are a proxy, or it's an easy way to get in and out of the market. But that said, it was a knee-jerk reaction, and the valuations are, asking for some consideration at this point.
Right.
Plus, some headwinds from global markets in the last week have also is out of the way. We saw the Federal Reserve reiterate the need to keep interest rates high, but not necessarily be as hawkish as markets were afraid they were going to be. That's why you saw some risk-off sentiment last week. We're a bit overdone for the Philippine market.
Okay, but Sandra, here's the thing. We're not expecting any data in the near future or any catalyst coming into September. How do you foresee now investors in equities would behave?
Actually, we're looking ahead to August inflation, which is out on September 5. And we are concerned about the recent uptick in rice and oil prices, which may show a little bit of or at least the momentum of disinflation kind of stalling to a certain extent. Now that can, depending on the degree of stall, or maybe it will be a higher print on a month-on-month basis, the narrative of transient or continued disinflation might be challenged, and that can lead to a headwind or weighing on sentiment. So I think for at least for next month, we're likely going to recover from these support levels and trade at a certain range, maybe until maybe even 6.8, 6.9 level. But then again, if we see inflation kind of higher than expected, that might weigh on sentiment.
Because that's really it. Inflation is really a concern of a lot of markets, not just in the Philippines. Now, for the Philippine scenario, we're seeing tightening of spending due to inflation. Consumers now avoiding borrowing, of course, due to sustained high interest rates as well. Now, how significant now do you think this would impact consumer companies and temper full-year bottom lines?
Actually, we're already seeing that in the second quarter corporate earnings of consumer sectors. No? So the bottom line has clearly been impacted, and there were misses in they missed consensus estimates.
Right.
Clearly, the high inflation that we saw from last year has impacted the disposable income of consumers. But that said, the outlook, while it may continue to be downbeat, it's more of an inflection that we're looking at. And since we're coming from a higher base,
Yeah.
so the ability of the consumer to recover on their on inflation expectations as well can lead to a healthier or a more robust outlook for the consumer sector, at least going into next year.
All right, Sandra, I'd like to get your view on some news stories now. The latest Moody's Analytics report seeing China's weakness affecting neighbors in Asia. Although a recession is unlikely, they say, the period of robust growth may move to a much later horizon. That's by middle of next year. Are you seeing growth decelerations now compared to the first quarter when we were so optimistic about, there was so much rave about ASEAN bright spots, including the Philippines and Vietnam? Has that changed now?
Well, a lot has changed from the beginning of the year in terms of outlook. But in terms of trade, we are less sensitive to China weakness than our neighbors, as our GDP relies more on domestic consumption for growth. Unlike Vietnam, for example, that is more China-centric from supply chain for exports. That said, there is some dependency there, particularly maybe on the semiconductor export side. So that will have an effect, but we do think we have downgraded our earnings expectations for the Philippines as well, more due to government spending not being there. Less on the export side. While it is a concern, the main driver for our downgrade of earnings growth expectations for the year is really due to the inability of the government to spend.
Okay, that's interesting because the same Moody's report pegs now a lower growth for the Philippines may fall below the 6 to 7% target of government unless, of course, there is fiscal policy repair and exports have to improve. Now, what are you seeing in terms of how the government is responding to these challenges in both fronts, improving exports or even arranging or making fiscal policy changes that would somehow save the economy?
The national government really needs to get reacquainted to spending coming from the 3 years of pandemic lockdowns. There has been there's now a shift, no, to since we've returned to full mobility, and spending needs to get reignited as programmed. So that's what we think is lacking, and to a certain extent, it needs to play catch up. So the risk here is the national government is not able to do it as quickly. And also on the policy side, there is while the BSP is very much ahead and they're able to achieve their primary mandate, which is of price stability, there is still a lot of external factors that are casting a shadow on that front. So I think more than monetary policy, it's really the ability to catch up on the spending that we would like to see.
All right. Lastly, on the Bangko Sentral, of course, we're seeing the central bank struggling to hold off rate hiking again, although there's still room for another 25 basis points. What non-policy interventions now do you see that could somehow improve the economy, that would prop the economy without raising rates?
The BSP has been quite communicative about the possibility of an RRR cut, just to maybe inject liquidity and stimulate, support the economy while not necessarily impacting so much the interest rate differential in case the Fed either stays put or even raises rates. But that said, more likely that the BSP will use the 25 basis point room that it had created for itself as being the most efficient policy tool that they can use right now.
All right. On that note, we thank you so much for the insight and for joining us this afternoon, Sandra Araullo of ATR Asset Management. Have a good day.
Thank you.